Hey, everybody, welcome back to the show, another live show. Hope everyone's doing well. As always, if you can give me a thumbs up in the chat to let me know everything's working, that would be great. I do have some some questions I want to ask you. The first one is, uh, it'll be, do you own Berkshire, A or B shares? Doesn't matter. And what I'm going to do is I got yes, no, and then I'm going to add an option yes, and I've been to a shareholder meeting. I'm assuming if the answer is no, you've never been to a shareholder meeting. I got the thumbs up. Thank you. This is interesting. Let me, having a technical issue with the poll. Hang on for a second. Bear with me. I don't know why that is. Is that too long? That's weird. Huh. We're going to cancel out of that and start over. Start a poll. Do you own Berkshire Hathaway stock? Yes, no, and yes, and I've attended an annual meeting. Huh. I'll just have to say a meeting. YouTube's being finicky. There you go. All right. So I thought I've got a follow-up question to that I think is interesting, but we'll start with that one. So I've been a long time shareholder of Berkshire. I wish I owned more of it. Most of it I bought, I want to say in 2013 or 14, I think. Of course, you own it if you own an index fund, U.S. stock fund, S&P 500 or whatever, you're going to own it there. The big news, I don't think the timing may have been a surprise to folks, including myself, but he's 94 years old. And, so the transition makes a lot of sense. I think the big question is, what does this mean for Berkshire Hathaway stock going forward? And I thought I'd just give you my thoughts. I think I don't know a lot about Greg Abel, to be honest. I know who he is. I've seen him field a few questions in past meetings, but I don't really know, honestly, a lot about him. Of course, I've not sold. I didn't sell any of my shares today. Don't plan to. And I expect I'll probably buy more at some point, at least if I think it's on sale, which it does from time to time. Since Warren Buffett took over and bought Berkshire, which was a textile company, I think it's gone down in value by at least 50% 3 times. So it goes, just like any stock. It can go down significantly. My take on the current situation is one. I think Berkshire is first of all, no one can replace Warren Buffett. I don't expect Greg Abel to replicate what Warren Buffett has done over the last roughly 60 years. I don't think anyone does. For that matter, I think if Warren Buffett were, let's just imagine he could stay on as CEO for the next 60 years, I think he would tell you he can't replicate what he did in the past 60 years, in part because the company is just too large. It's just, it's so big, you're just not going to be able to get the kind of returns, the compounding that you've had over the last 60 years. But even discounting that, I think it's probably unlikely that Greg Abel is as talented as I assume he is. Otherwise, Warren Buffett wouldn't have chosen him. He's not Warren Buffett. So I think that's, that's sort of the going in assumption. I think Berkshire is a very unique public company in the United States because it owns a lot of operating companies that operate independently of one another. They're very unique from one another. Think Dairy Queen and a railroad, car insurance company and utility. It's a very unique operation. And then of course you have the equity portfolio that Warren Buffett and others, including Greg Abel, have built up over the decades. And so it makes for a very unique company. Financially, it's about as healthy as a company can be. I mean, it's got, whatever 300 and I don't know what it is now, 50 billion in treasuries. I mean, it's ridiculous. And so, I just think it's an excellent company to own. I have no plans to sell anything, but we'll see what happens. I mean, Warren Buffett is and it's obviously it's earned, but he gets the benefit of the doubt, at least from shareholders. I remember when the tech stocks were going up in the late 90s before, it all crashed in 2000. And it was funny to hear people say, "Oh, Buffett's old. He doesn't know what he's doing. He's missed out on the tech boom. It's the internet." And it was the future, right? The internet and technology then definitely the future, but that doesn't always make it a great investment. And Warren Buffett saw that, and he ended up sort of being right. I kind of chuckled this weekend because Michael Saylor, who is, I guess, the chairman of Strategy, formerly MicroStrategy, it's just a Bitcoin company now, was sort of taking shots at Buffett, and I think he said something like he's the next Buffett. Which, even if I had the kind of ego that he does, which his ego is ginormous, you think he would have some sense about him, but he really doesn't. And so, I kind of view his shots at Buffett not unlike the shots people were taking of him in the late 90s. I'm actually on X looking for, I want to see what he said. It's like, what a Yahoo. Let's see here. If I can find it. Oh yeah, Berkshire Hathaway is 20th century Bitcoin. I mean, I guess you could just say he's just being goofy, I suppose. But he had something about Buffett, but I can't find it now. I don't know, maybe he took it down. Maybe I just can't find it. But in any event, he's not the first one to make those sorts of statements, and he probably won't be the last. But the reality is that over a 60-year period, Warren Buffett has proven to be, I think, the best investor ever. And let's see here. 29 of you own the stock. No one that's watching has attended a Berkshire Hathaway meeting? Okay. All right. I've attended 2. And I got to see Buffett and Munger. This would have been like around when I bought it. So I guess I bought it in 2013. I attended I think it was the 2013 and 2014 meetings. Lots of fun. And, I'm kind of regret that I haven't gone back since, but I am going to try to get back there next year, although I'm sure it'll be a lot different. Let me start a different poll. It's a question, but let's see here. If you'd invested 10K in BRK in 1965, how much would you, if you invested 10,000 in Berkshire in 1965, 60 years ago, how much would you have today? We'll do 1 million. We'll say 10 million. We'll say 100 million. And we'll say 1 billion. Give it your best shot. I want to see if Testfolio, if I put in a ticker for BRKA, how far back can I go? Can I go to 1965? Do they have that much data? Let's find out. Where's 1965? Oh, I'm in 2065. That's no good. Whoops. 1965. Golly, come on. 1965, January 1. Yeah, it doesn't go back that far. I'll try one more time. No. It's kind of a bummer. Maybe I was in the wrong tool. No. Why is it not? I'm having like technical difficulties. No, I guess I'm not. I think Testfolio is. Let's try something else. Here we go. Bear with me. And then I'll get to your questions. I promise. I doubt it goes back this far. Let's see. Here we go. Starting with 10,000. It doesn't like the ticker. All right, well, hang on. Let's just try BRK. Invalid. That's disappointing. Maybe it's just maybe that's what we do. No, it's not working. I can't do that. But I know the answer, so it doesn't matter. Let's see how we're doing. Good guesses, good guesses. All right, well, we'll let that run for a little bit, and I will get to your questions. Before I started the show, I saw one. Let me see if I can still... no, I can't get back to some earlier questions. So I will start. Let's see. Noreen's here. She told me the game over, referring to my chess game. I really didn't play well, but I won. He allowed me to fork his king and rook. That's never a good thing. So this is an interesting point. The transition Buffett to Abel is like the transition Jobs to Cook. We'll see. I mean, that certainly was a transition that, it was unclear to me. I'm trying to think what year Steve Jobs died. I owned the stock then, right? No, I didn't. He died in 2011. I bought it in 2013 for the first time. So still, though, I think it was still a question about how things would go. And it's interesting because Tim Cook he doesn't have the brilliance in terms of, design and whatnot that Steve Jobs did, but he has other, apparently with supply chain, there's no one better. And he's obviously done extremely well for Apple. It'll be interesting to see how Greg Abel does with Berkshire. Wouldn't you hate to follow in the shoes of Warren Buffett? I don't know. That would not be my plan A. I got to tell you that. All right. PH says, not a chess player, but just watch the Queen's Gambit. Yeah, it's a good show. Good show. All right. Oh, Dave pointed out he doesn't read it, but he does read the annual, or doesn't own Berkshire directly, but he does read the annual reports. Highly recommended. They're phenomenal. Phenomenal. When I was at one of the two annual meetings, there's a place, a jewelry store, I forget the name of it, but it's in this really, honestly, it's like a strip mall. I don't know. Warren Buffett, it's part of this weekend, was there, had a lot of security around him. I don't know what the relationship is with the jewelry store. But it was in this like strip mall. There was like a little indoor part of this tiny little thing, really. But in the indoor part, they had Patrick Wolf, who's a chess grandmaster, was playing, I don't know, maybe a half a dozen people simultaneous, playing them at the same time. He was blindfolded, so he couldn't look at any of the boards. I wanted to get in on that, but I was too late. And then he had a woman who was an Olympic table tennis champion, and she would play, like you could play her like 1 or 2 points. And I remember that was the year my son and I went. And he played her. He got a point against her. I don't know if she was being nice, but then she turned it on, and and that was the end of that, and scored a couple of points. But it was a lot of fun. All right. Yes, you do own it if you own the S&P 500 and you own Berkshire, and we can actually look at that if we go to Morningstar, because it'll be a top 10 holding. So we can just put in, doesn't matter which one, we'll put in SPY, which is a S&P 500 ETF. And if you go to the portfolio, it'll show you the top, I think, 30 holdings. Yeah, but there's Berkshire. So you 2.04%. So for every $100, you got $2, $2.04 in Berkshire Hathaway. Yeah. So Steve, this is interesting. He owns 48 shares. Now, I don't know if that's A or B. He says, I'm hoping new management decides to start giving dividends. So Warren Buffett is well known for not paying a dividend. And as an investor in my taxable account, I'm grateful that it doesn't pay a dividend. For me, the stock would become less interesting if it started paying a dividend. Because if I need money, I'll just sell shares. And I can control that. I'm not going to pay, I'm going to pay, well, I might pay qualified dividends if they paid a dividend. I might still pay long-term capital gains, but I control when, I control the amount, and not every dollar would be taxed, right? Because it would only be the gain. So for me, I hope they don't start paying dividends. The other interesting thing, and let's go back to the poll. So 6% said $1 million, 40% said 10 million, 43% said 100 million, and 10% got the answer correct, $1 billion. And there's no dividends. I think the mistake people make is they think of dividends as the way that you get compounding. Dividends have nothing to do with compounding. Yes, it's true. If you get $1,000 dividend check or deposit into your brokerage account and you reinvest it, it could be into the stock fund that paid you the dividend. It could be a different stock fund, different stock, but you reinvest it. That's putting money back to work, and you're going to earn compounding on that $1,000. And if you do that every quarter, right? But there's nothing special about dividends. If instead of $1,000 dividend check, you got a $1,000 check from your aunt or uncle as a gift, and you deposit it into your brokerage account, that's going to start compounding, and you invest it. There's nothing magical about the fact that the $1,000 happened to come from a dividend. And it's true that when you compare reinvesting the dividends versus spending the money, the difference over decades, and this is often what you see in articles and whatnot, is going to be substantial because you're reinvesting that $1,000. But you could just forget the dividends and just say you're getting a $1,000 check from your aunt or uncle. Well, investing it, you're going to have this much after 30 years. If you spend it, well, you won't. I mean, so dividends in and of themselves aren't required for compounding, right? How has Berkshire been able to compound over the last 60 years without paying a dividend? And the answer is the real compounding occurs when a company makes money, has free cash flow. Yeah, they make a profit. Some of that has to go to just keeping the business going, but they take the excess cash and they reinvest it into their business. In the case of Berkshire, they buy other equities, they buy whole companies, they perhaps invest money in their existing companies, and that's how the compounding happens. So you don't need a dividend to compound. It's different. You think about interest from a savings account. It's the same thing. They pay you interest. If you put it back in, you start earning more interest. You earn interest on the interest. If you spend it, you don't. Anyway, I know. Don't get me wrong. I love dividends. I love the dividends that I get, but particularly in a taxable account, I'd much prefer to have control over it. That's just me. And it's apparently Mike as well. So Parth wants to know how I do a valuation of a stock. So I've not really sat down and tried to value a stock in a long time. I remember I did it with Apple when I bought it in 2013 and got out a spreadsheet and did some research. And I'm no stock valuation expert at all. Conceptually, the idea is to figure out what kind of income, profit you think this company, let's back up. Let's forget a public company for a moment, because their financial statements are complicated. A company like Berkshire's got a lot of moving parts. Let's just imagine we wanted to invest in a piece of real estate. We were going to buy a single family home or a condo, and we were going to rent it out as a business? And how do we want to think about the value of that property, not as a place to live, but as an investment? So you could figure, what would you do? Well, you'd figure out, some estimate of what you think you could rent it for. Let's say it's rented now. You're going to buy it from another investor. They're already renting it. They've got a tenant in there. You know what the rent is, and I guess you can assess, is that fair rent or not? Maybe you can increase the rent. But in any event, and you're going to say, okay, what are my expenses? Insurance, if you're financing costs and maintenance. And then you're going to want to think about capital improvements that you'll have to make. In other words, improvements you'll have to make to the property that won't get expensed right away. They might get depreciated, like a new roof or a new HVAC system, because eventually those things are going to wear out and they're going to have to get replaced. And so you want to account for that, but ultimately you're looking at what's the money left over? What's the cash to the owner after the expenses are covered, after an estimate of capital improvements? And in a public company, what you often look at is you compare depreciation and amortization with new capital improvements, and you sort of compare the two. And in fact, actually, I have them here. I think these books, by the way, this wasn't planned. They were just sitting out there. 2 good books on Warren Buffett. I think they talk about this concept. Warren Buffett calls it owner's earnings. It's basically the earnings that we would get as owners after all the expenses are paid, and we cover capital expenditures that are going to have to be paid. And then the trick is to get a sense of how reliable do I think that stream of income is. And so here a lot of judgment goes into it. But it's one of the reasons that Warren Buffett seems to prefer a company like Coca-Cola over Google, let's say. And Google's been a fantastic company to own. But in terms of understanding the risk to its future prospects, I think Warren Buffett would say, at least for him, and here he's being modest, but okay, Coca-Cola is a lot easier to understand, and it's a lot easier to get comfortable with what the future might look like. It's not guaranteed, of course, but it's a little more predictable. I was looking up here to see if the concept of owner's earnings is discussed here. He discusses it in one of the shareholder letters. Yes, it is. So this discusses owner earnings, at least in 2 different places. I imagine this one does too. Is this yeah. And then you're just discounting it back to the present. What's the value of these estimated future owners' earnings discounted back to today, which is not a hard calculation to make, say in Excel or whatever. But the trick is probably figuring out the discount rate. And at this point, I've probably lost all of you. You've probably all tuned out. There's a lot of judgment that goes into this at a lot of different levels. And of course, in practice, I'm just seeing if they talk about owner's earnings in this book. Yeah, they do. So it's a concept that Warren Buffett's talked about. You can Google it. You can get one of these books. There's a lot of ways to go wrong, and there's a lot of uncertainty. And so for me, when I've invested, particularly Apple, it was, I thought, significantly undervalued. In other words, I could have gotten a lot of things wrong in my valuation and still been okay, because I'm by no means an expert in valuing a business. I'm comfortable around financial statements, mainly because of my work at the Public Company Accounting Oversight Board, but I'm by no means an expert for sure. That's an understatement. The other thing too that I'll say is that if Warren Buffett, I think he said he reads about 60 financial statements, 60 like 10Ks or maybe Qs as well, quarterly statements a month, he said. I mean, he's been doing that for decades. And it's that kind of commitment that I think it takes to really be a great investor. And most of us probably aren't going to do that. And that's okay. If I wanted to invest all of my time into being an investor, I would be sitting here reading all day long. And I don't want to do that. Now, if stocks tanked by 50%, I'd probably buy a few because I could do a quick analysis and say, I can be off by an order of magnitude. And yeah, Microsoft at a 12 PE, I'll take it. Thank you. Right. But we're not there. We're not anywhere close. All right. What do we got? What's next? I wonder, I guess I asked if anyone had been to the Berkshire Hathaway meeting. Maybe people have joined the live stream since that question was up. Because I was kind of curious if anyone went this year. It would have been neat to be there this year. But yeah, Ted points out that this is sort of the issue that Warren Buffett has himself discussed. It's such a big company. I mean, let's imagine it found a good investment for $1 billion company, which, would be considered a small cap, right? But I mean, for Berkshire, it's probably, they might buy it. I don't know, maybe a bolt on to one of their existing companies or something. It's probably be more of a strategic purchase, I think, than just pure financial at that point, because it's just not going to have any effect. I don't know what materiality is on their financial statements, but they're a $1 trillion+ company. So you got to find really big deals, and it's hard to get really big deals at a steal, which is what, or even a favorable price, which is what he's trying to do. Let's see. Why did Buffett want a public company? I don't think he bought Berkshire with the plan to do what he ended up doing. He really liked super cheap companies, but sometimes companies are cheap for a reason. And they continued to operate it, I think, until the textile part of the company, I think until 1985. I think it lost money for a lot of those years. But I don't know that, because before he had a private partnership that he invested in and eventually liquidated that, or, terminated it. I don't know if when he bought Berkshire, he was intending to effectively use it, I guess, as a holding company, or I don't know if that's the right term for the structure, but I don't know what his plans were. I'm sure he's discussed it, but I just don't know. Here's a good question from Josh. What is your opinion on Christine Benz, who's at Morningstar? She's also part of the Boglehead group, and I've had an opportunity to meet her at some Boglehead conferences. Article saying that cash is a better diversifier for stocks than bonds. I'd have to go back to the article to really give you a strong opinion on that. And also to understand the context in which she was saying it. One thing to keep in mind is that when we think about the correlation, right, between two different assets, the correlation can change over time. So sometimes it could very well be the case that cash is a better diversifier than stocks for some period of time. But I also suspect there are times when bonds are, although we'd have to know what kind of bonds we're talking about, right? That's important. So long term, I mean, long term, your portfolio is going to do better. If you look at history, in the U.S., long term, your portfolio does better with bonds than cash. And by bonds, I'm thinking intermediate term treasuries, maybe intermediate term investment grade corporate bonds. Your portfolio will do better. Bill Bingen looked at this question in one of his papers, not the 94 paper that gave us the 4% rule, but in maybe his 97 paper. Was it asset allocation for a lifetime? Anyway, what he concluded was, at least in terms of the 4% rule, he wasn't looking at the question of what's a better diversifier. It's funny, I Googled this and my site comes up first. Let me see if I can, I don't think, this might not be the paper, or I can't search it. Let me see. I'll show it to you. This is what I'm looking at. Anyway, what he says is, yeah, you can have about 10% of your in cash, and it doesn't really affect the safe withdrawal rate. I don't know if it's this paper. But you go above that, and it does start to affect the safe withdrawal rate starts to go down a bit. Again, he was looking at history. Things can change over time. It may not be this paper. By the way, I am returning to a project that I started last year, where I'm going to be making available to you a more robust set of tools, books, and research papers that you can, on my site, that you can go through and look at and read and whatever you want to do. It's still a work in progress, but I have returned to that, and hopefully we'll have some things to share with you in a couple of weeks. Keith says, if the new CEO buys 300 billion of an index fund, is that possible? I don't think he's going to do that. I don't know why it wouldn't be possible. You might have to do it over a period of time. Okay, here was one of the top questions, and I missed it earlier. But CM says, what are your thoughts on VT and Chill? So VT is a total stock fund by Vanguard. It invests in U.S. and international stocks. I can show it to you here in Morningstar. And the idea, for those that might not be familiar with the term VT and Chill, and you hear it in different contexts, but the idea is, so what if I just own VT, this one fund, at least for all my stocks, and that was it? Just kept funneling money into VT and called it a day. And I think that is perfectly reasonable. This is the fund. You can see it's got 61% in U.S. stocks and 37% in international, and then some cash. Top companies are primarily U.S. based, I'm sure. Look, the top 10 largest companies are all U.S. companies. That wasn't the case in the 80s. Let's see, how far do we have to go? There we go. Taiwan Semiconductor. That's unreal. And no more. That's the only one on the top 20. Wow. Anyway, I think this would be perfectly reasonable for your stock portfolio. Absolutely. I've owned VT in the past, but I don't now, because I ended up moving just to a Vanguard target date retirement fund for our 401k. Okay. My wife and I have started watching The Pit. Really like the show. I said in the newsletter that I haven't covered my eyes watching TV this much since the last OSU Michigan game. But it's, in all seriousness, it's not that bad. Definitely a grown-up show. Okay, don't turn it on with the 5-year-old, the elementary elementary school kid in the room. But well, I wouldn't. I guess you guys will make your own decisions. But I really enjoy the show, as does my wife. Okay. Ted says he would have rather have gone to the show to see Munger. It was funny, though, because, Warren would give this answer, and then Munger, Charlie, anything to add? I got nothing to add. Nothing. Or sometimes he would. And he would say things, he would say things that Warren Buffett wouldn't say. Munger was a bit edgier than Warren Buffett was. It's funny, the 2 times I went, I don't know if they still do this, but at the beginning of the meeting, before Charlie and Warren would come out onto the stage, they would play a prepared video. And at least the 2 times that I was there, the video was the production quality was very good, and it had actors in it playing different roles. So one of them was Schwarzenegger, and he was trying to find someone to be the villain to his character in a movie he wanted to make. And he's, considering Warren, and Warren's like, he wants to do it, but Arnold said, you're just not you're not tough enough. I need someone to, if you're going to be a villain, and you're not cutting it. So he ended up picking Charlie. At least that's how I believe it went. But the first one I saw was before I'd seen the show Breaking Bad. And this was the funniest thing. I didn't get it, though, at the time. It was only until after I went and watched Breaking Bad. But this video comes up, and you see, if you've watched it, Breaking Bad, you know this. There's the camper, and it's in the middle of the desert, and they're cooking. And they're in there, White, and I forget the names now. In the event, they're working away. You don't know what. And there's a knock at the door, and they open the door, and it's Warren Buffett. And it turns out that what they were cooking was peanut brittle. Because they own See's Candy. So they were making peanut brittle, and apparently Warren Buffett had decided he was going to corner the market in Albuquerque for peanut brittle. Hysterical. It's got to be on YouTube now. I don't know. Very funny. I don't know if they still do that, because the meeting is broadcast. I watched it on YouTube, live on Saturday, most of it. But if they still do videos like that, they don't show that part of it. So, question about LifeX bond ladders. So, I've not done a deep dive on LifeX, and I have had some questions about it. I will say the idea of this, as I understand it, is, let me take the comment down so you can see everything. So here's an example of one that you just put your money in, and it basically creates a ladder for you from now, 10-year ladder of treasuries. I think they're all treasuries. Yeah, treasury notes and bonds. So a bond would be longer term. Those are just terms that they use, bills, notes, and bonds, to distinguish the duration. I think notes are up to 10 years, but someone correct me if I'm wrong. Bills are up to a year. Bonds are longer than 10. I think that's the cutoff. In any event, and it will pay out, give you a payout of a certain amount each year. You can see the distribution rate right now is 11.5%. Let me make it a little bigger for you. The one thing I would tell you is, keep in mind, that's not interest, right? Well, some of it, you're earning interest, but they're returning some of your capital to you. And in fact, this right here tells you that. Hey, they're saying 67%, I think it'd be 67% of this, I suspect, we could look at the details, is a return of capital. In other words, giving you back the money you gave them. You invest 100,000, you get 11,500, let's say, in year one. 67% of that is us giving you back that part of your 100 grand that you gave us, and the rest would be interest. It's expense ratio of 25 basis points. I mean, I think all things considered, that's, and reasonably inexpensive. Obviously, you could do this on your own and not pay that 0.25% in expenses. But as the questioner was kind of pointing out, this is just easy. So I've not found anything about this that tells me it's not at least worth considering if it meets some of your financial goals. I do wish the bid-ask spread, I guess that's not bad. I don't know. So so the thing to keep in mind is there is a fee to buy an ETF, right? Your broker is probably not going to charge you an actual purchase fee like you might pay if you buy, say, a Vanguard mutual fund from Schwab. But there is a fee, and it's that bid-ask spread. Yeah. It's just something to keep an eye on. But it strikes me as a reasonable product. If it meets your financial goals and you don't want to, deal with it on your own. Another thing, let's see here. And I was thinking of bullet shares, but they're going to have fees as well, and it's going to be more work. I'll just show you this. Let me see if I can find, I think they have treasuries, right? Well, they don't. They have investment grade. So these are ETFs that sort of act like individual bonds. You invested in BSCP, and they're basically going to give you all your money back end of the year. And then Same thing here, end of 26, end of 27. So you could build out your own ladder just by, but more work. You have to buy all 10 of these, and they don't have treasuries. They just investment grade, a little cheaper, 10 basis points. And there are other similar products. I've never owned any of those, but so I don't have any personal experience with them. The big question for me is, how do we find the next Berkshire Hathaway? What makes that challenging, among other things, is that there may not be another Berkshire Hathaway, at least not during a time period that would be relevant to us. Okay. Yeah, the interesting stories about Warren Buffett. When I was there in I think it was the same year my son went. The first year, I took my wife and daughter. Then the next year, my son couldn't go. The next year, I took my son. Warren Buffett was talking about, I think it was a compensation plan that Coca-Cola had announced that had to do with stock options. And it was a question from the crowd. He takes questions. And he walked through his analysis of it, and he did the math in his head. And it was just, to me, it was just extraordinary. Extraordinary. You think about three things about Warren Buffett that stand out to me. And he reminds me very much of Magnus Carlsen, the best chess player, I'd say probably in the history of the game, but certainly today. One, he started when he was young. He bought his first shares at age 11. I mean, that's just not normal. It's great, but it's just not normal. I wasn't buying stock at age 11. I think I was playing with Lincoln Logs. And that's because we couldn't afford Legos. And Lincoln Logs are great, by the way. He started at age 11. So that's one thing. His mind, I mean, he's obviously brilliant. And, his memory is, from what I've read and just listening to him, is extraordinary. Even it's extraordinary at age 94. Its ability to crunch the numbers, all of that, just a brilliant mind. But the third thing, and this is where I don't know how Greg Abel will, how he measures on this third point. I guess time will tell. But Warren Buffett, he talks about judging yourself through an inner sort of scale rather than what other people think of you. I mean, reputation matters, but Warren Buffett knows who he is, knows how he thinks, and that's what's important to him. So he's got this sort of internal measuring stick for the way he lives his life and the way he invests. He's not trying to show off or convince other people that he's good or brilliant or whatever, although we all know that. He's not. That's just not who he is. He doesn't need that sort of confirmation from other people. And he doesn't have this overwhelming desire to be liked. I mean, he just doesn't. And you see the folksy side of him, but I suspect in business he's pretty ruthless. I don't mean that in a negative way. I think he's obviously conducts himself completely above board ethically and everything else. But I mean, I think, he even kind of alluded to it. When he announced that he was stepping down, he said, "I have no plan, no intention to sell a single share of Berkshire." He's going to gives a lot of shares away to charity, but he has no intention. I like how he said it. He didn't say he'd never sell a share. He said he has no intention to sell a single share. But then he made a comment that was basically like, by the way, that's a pure economic analysis. Things change. I'll be selling. He didn't say that, and that's who he is. And I don't know, Ajit Jain, do I have that right? I may be mispronouncing it, but he runs their insurance. He strikes me as the same way. He strikes me as a brilliant man and the same sort of internal compass that Warren Buffett has. I don't know about Greg Abel. That's a I, the I haven't been able to. There's something that kind of makes me wonder if he's a little different in that regard, and that'll be interesting to see. Okay. Oh, here we go. What's up? Has been to a meeting. Nice. I'd wanted to like go, and then if others went, we could all meet up, and maybe we'll do that next year. I'd still go. I mean, it's not going to be the same. Of course, Warren Buffett's still going to be chairman starting January 1. And I don't know if I assume he'd be at the board meeting. And I don't know if I guess he'd let Greg Abel sort of lead it. He should, I guess, right? But he might still be there. Okay. Braxel says, am I better running my own portfolio or letting Fidelity or Vanguard manage it? Well, from a fee perspective, it's clearly better to run your own portfolio, but that doesn't necessarily answer your question. I don't know how comfortable you are managing your own investments. So that's a question that I think only you can answer, right? As between Fidelity and Vanguard, I mean, Vanguard's going to charge you, I think it's 30 basis points. Fidelity, it might depend on how much money you have with them, but I want to say a lot of their managed accounts come in around 40 basis points. They may have options that are more expensive than that. I know they're direct indexing, which I'm not by and large a fan of, but that separately managed account, I think is 40 basis points. I think it's 40 basis points at Schwab. I have mixed feelings about Vanguard. I think they're tending to move a little bit away from just pure index funds. Time will tell whether that's a good thing or bad thing, but you might be able to have them manage it for you and stick to index funds. I don't know. But I think managing our own portfolio is extremely easy. But I've been doing it for 30 plus years, so I don't have Warren Buffett's memory. I heard. I don't know if this is the exact number, but that since his 96% of his wealth he's accumulated it since he turned 65. And that sounds about right given compounding. But in any event, you get a couple. You don't need a lot of funds. You stick to index funds. It's very simple. You have to be able to control your emotions, and you can assess for yourself how that where you stand on that. It was interesting. Again, going back to Warren Buffett, he made a comment on Saturday at the meeting where he said, "Look, what's going on in the market this year? It's really nothing. If the market has caused you angst this year, that's kind of a problem because this is really nothing." And by the way, I don't think what he meant by that was everything's going to be okay. I think it was just, look, our financial system at the moment's not broken, and it was only 15%. We're back up some. I don't know. Where are we for the year? S&P 500 is it's down 3.7%. I mean, that's year to date. Over the last 12 months, it's up 9%. I mean, this is nothing. This is nothing. Kat wants to know if I can analyze a 3-fund portfolio versus a factor portfolio. Well, not that way. I mean, it would depend. I mean, there's a gazillion different ways to tilt your portfolio in some way. So you could, one of the factors is big companies versus small, right? So you could maybe have a 3-fund portfolio, but put 10% of your U.S. stocks in small cap. There's value versus growth. So you could make it small cap value. And then the question is going to be, over what period of time do you analyze it? Because, one portfolio could win in one period. The other portfolio could win in a different period. I've come to believe I've come to believe that there's nothing particularly special about a particular factor. So that would include small cap value. This is where Paul Merriman and I probably disagree. I think, if you look at, I'll show you what I mean. If we're looking at VT, it doesn't really matter the stock or the ETF. You can imagine all of these boxes, these 9 tic-tac-toe board boxes, as factors. And there are other factors, but small company are down here. Value would be over here. But if you compare the total, like an S&P 500 or total US stock market to one of these factors, at any point in time, a given factor will outperform. By definition, it has to, unless every square, I'll call it, performed exactly the same, which of course never happens. There's always going to be some approach that outperforms the average of all the approaches, right? The problem is which one outperforms changes over time. It's not the same. I think for a long time, people viewed small cap value, and I viewed it this way, that small cap value was somehow special. And it's true, for a long period of time, it outperformed until it didn't. And now for the last, couple decades, it hasn't. Maybe next year it starts performing better. But there's always going to be, and it has to be that way. It's no different than the 500 stocks in the S&P 500. Some number of them are going to outperform over certain periods of time. They have to, right? Because the S&P 500 is just an average. So some are going to be up, down. And so I've gotten to the point where, and I have a small cap fund, by the way, and I'm happy to have it. But I invested in it 6-7 years ago, and it's got gains. I'll probably never sell it until I need it. I'm fine with that. But I would probably have simplified all of that if I were doing it today. So we could find a factor portfolio over a certain period of time that outperformed. But I think I've come to believe it's not going to be because any factor is particularly special. Now, what you could try to do is figure out which factors are going to do better, in the near to medium term time period, maybe based on valuations. I just find that I'm just as likely to mess that up, so I don't bother with that either. Well, I can't verify this claim, but someone says they're a FedEx driver in Omaha and they deliver all of Bucket's packages. What's the order? I mean, it's probably a breach of privacy. Don't tell us what he orders. I wonder if he ever bought my book. Would it get shipped to him? He probably didn't. Okay. Let's see. Yes. I think that's the jewelry store, right? Here it is. In fact, here's Berkshire Hathaway shareholder pricing. Enjoy up to 45% off on select jewelry. Wow, how much does that cost? It's a Citizen. What, we got a pop-up? I will tell you, they sell some incredibly expensive jewelry at this place. And that was a decade ago. Well, here we go. You got a $16,000 ring. I guess if you've got an A share, you get some change back. All right. Oops, that's not what I wanted. I want this one. From Amar. If I own a small amount in gold, and GLD is a gold ETF, should I consider it part of my bond or equity? I don't think it would be either, right? Wouldn't you kind of put it in an alternative category? I think that's how I would think about it. I wouldn't think about it as either bond or equity. Alternative, could call it commodities, but if you look at some portfolios, in fact, someone emailed me yesterday on things like the all-weather or the butterfly portfolio. Golden butterfly? I should know this. Yeah. It has allocations to gold. I thought, 20% in gold. and that's separate from bonds and stocks. So I wouldn't, yeah, I wouldn't think of it as either myself. All right. Grok said 550 million. That's actually good. Let's see here. How much? Let's see. I'm going to do, we're going to get serious. We're going to do O3 because it uses advanced messaging. How much would a $10,000 investment in 1965 in Berkshire Hathaway stock be worth today? It's thinking. Well, I'll let it think. By the way, sometimes it takes several minutes to think. The billion came from an article that I read today. I didn't check the math. Should one hold BRKB? That's not it. Where'd it go? Here, in an IRA, in a Roth IRA. I think it's a perfectly reasonable investment to hold in a Roth. I like stocks or stock funds in a Roth. I happen to own ours in a taxable account. Keith says, how do I stay motivated watching my TSP, Roth IRA, and HSA barely move every month? When does this compounding start exploding? I'm about 7 years in. Well, I would think you'd have substantial growth over the last 7 years. I mean, the stock market's been on a tear. I know 2022 it was off, but the year before that, double digits. 2 years after that, double digits. Were basically flat this year. Oh, hang on. Hold that thought. Let me get the comment off. Look, I get a chart. Now this says it's only 770 million. Wait, 700, what? Oh, that's today. Hang on. Where are we? 405 million. That's what it says. I don't know. Well, I know this number here is wrong. 4 million% return. It's higher than that. That I know. So, or I've read that it's higher. But I like this. Look at this. ChatGPT. I get a chart. It's interactive. And it only thought for 28 seconds. You can actually click this and it'll tell you what it was searching. Yeah. So maybe the $1 billion is off, but not according to the article I read. Anyway, I can assure you it's a lot of money. So Steve makes an excellent point. Steve says, I have B shares and I'm old. I don't know what that means, but I get old. He says, I would rather collect dividends than try to figure out what to sell, how much to sell, portfolio impact. I think that is a thought that I've had a lot. One of the attractions to dividends, the downside of dividends is that they take choice. They take choice away from you. You don't get to decide when and how much, and you got to pay taxes. So you don't get to choose. The upside of dividends is you don't get to choose. You don't have to choose. I mean, it's a plus and a minus. And I think Steve makes an excellent point. I mean, again, it may not be the most tax efficient way to pull income from a portfolio, but goodness, it's certainly an easy way to do it. And by the way, not a bad way. It's not a bad way to think about it. Now, I think if you take it too far and start tilting your portfolio to crazy investments because they claim to give you an 8% yield or something, that's when things really go off the rails. But if you have a basic market portfolio and you're getting your dividends and you're spending your dividends, I think there's a lot of appeal to that. I really do. All right. Chuck bought some shares of Berkshire. I thought about buying some shares today, but I want to buy when it's cheaper. Well, it was down 5% today or thereabouts, but it's still not cheap. All right. Let's see what we've got next. Yeah. So Rob opened my eyes to how dividends actually work, and it seems like most people don't get it. They act like it's free money, and it just isn't. Yeah. Honestly, that was an eye opener for me. I mean, some time ago. But I think if I went back far enough, I thought dividends were, I've got my stock and I'm not selling any of it. And dividends are like interest. That's how I thought about it. Dividends are like interest from a savings account, and it's not. It's like giving you some of your investment back. And the hard part is that you don't sell any shares. The dividends are usually very small percentage. So on the day you get your dividend, the stock could actually be up. If the market's having a good day, and it kind of feels like free money, but you just always have to remember the dividends come from the cash in the company's checking account. May not be an actual checking account, but you get the idea. And so you take, $100 million out of a company's cash to give to its investors, and the company's worth $100 million less, right? I mean, it's pretty straightforward. Chris says, I find it intriguing to watch what Berkshire does with their cash position over time. Just another indicator. It does get a lot of press, particularly when the cash balance gets so high. Part of it is, of course, they've got to be prepared for catastrophes that their insurance divisions have to pay out on. But I do think it reflects Warren Buffett's view that there aren't many good deals out there worth buying, and he's willing to sit on a lot of cash for long enough until he finds a good deal. It'll be interesting. Well, may not be fun, but we really haven't had a really bad market in a long time. I understand 2022 was down, interest rates are going up, inflation, and the COVID, dipped for a month or two, but we've not had anything like tech bubble burst or 08, 09, where we thought maybe the financial system might collapse. And if you look at we got to keep this in perspective. If you look at the Shiller PE, so this right here is 2008, 2009. It was less than half. If we went back to that level, we'd lose, the S&P 500 would have to lose more than half its value. And if we went all the way back to the early 80s, I mean, the PE was 6. That's just extraordinary. And when you look at the average, the mean is 17. Of course, over time, the mean keeps changing because we've been above 17 forever. I mean, other than the blip in 09, could we call it a blip? When were we at 17 last? I guess 1990. I mean, that's a long time. So, by the way, I'm not predicting that we're going to have some market calamity anytime soon, but I'll be here when we do, Lord willing. We can talk about it. I used to have a spreadsheet called the Doomsday Fund. This is a true story. Doomsday Fund. And what I would do is I would assume that our investments lost half their value, our house lost half its value, and I lost my job. And then I would calculate how long we could survive. And by survive, I basically meant, eat and not lose the house. And I would go in and say, okay, what would we cut? We'd sell a car because I'm not going to work. We'd cut all these expenses. I actually calculated all this, cut all these expenses. And when I looked at it, I said, well, we could survive for a fairly long time. I mean, it might not be pretty, but we could do it. It actually gave me some level of comfort. Maybe I should calculate your doomsday fund. Oh, wouldn't that be fun? Okay. What time is it? 8:05. We're doing okay. What do I think about Buffett's comments on tariffs? Well, first of all, and this goes back to his memory, someone asked him about the Fortune article he published. He wrote, I think in 2003, and I had mentioned it on a show earlier this year, but he remembered it. Now, maybe he went back and read it recently. I don't know, but he remembered it in detail. He even remembered a part of it where he would cut breaks for emerging market countries, which I remember reading a couple of months ago when I read the article. But sort of the details of how to try to balance the trade deficit. But anyway, I just found that fascinating that his memory of that was so clear. His memory of it's better than mine, and I read it a month ago. I thought his comments on tariffs were excellent. And if you haven't watched it, you can find it on YouTube. It was near the beginning of the Q&A, I believe, but it could have been a half hour in. I don't remember exactly. One of his points was, and I'm of course paraphrasing here, but he said, look, we're the wealthiest country in the world, in the history of the world. And, should we be trying to win at everything so that the rest of the world is just jealous of all of the wealth that we have? Now, I don't think his point was that we shouldn't try to negotiate trade deals, and we shouldn't try to be, make sure we're treated fairly, particularly with China. But I do think what he was saying was we ought to appreciate the position that we're in, and just maybe as a country not be so greedy. He didn't word it that way. And I just generally don't like the approach that's been taken. It could, maybe it'll get countries to the bargaining table and things will, it will resolve itself in some way. There's allegedly been some movement with China. China is different to me than a lot of the other countries, but even the way we treated our allies, I'm not happy with that approach at all. And I thought his comments were excellent. You ought to listen to them because my rendition of them is quite poor. Are CDs good investments? Well, they can be, depends on your goal. Could be a good place to park cash. I personally prefer T-bills because you don't pay state and local income tax. But I've owned CDs in the past. I owned CDs in 1982. They were paying 16%. And I would only invest in 6-month CDs. I wouldn't try to lock it in for longer than that because I was afraid interest rates were going to go up, as was everyone else in the world, by the way. But yeah, they can be. Just depends on the interest rates, your financial goals, how long you want the money to be locked away. They're certainly not good. If you're looking to compound your money, to beat inflation, to have long-term, growth, CDs are not the place to be, in my opinion. But they can be a good place to park cash. Again, I think I probably prefer T-bills or a T-bill. I bought some Vanguard, some V-bill today, VBIL. It's like SGov. It's 2 basis points cheaper. And I bought some of this today to hold some cash that we'll be spending in the next 3 months. Let's see if I can understand this question. I'm interested in how the news affects the stock price. Is the news all reflected instantly? Well, I think material relevant news of a stock, whatever it might be, can be reflected really quickly, right? And we've even seen this, like when there's an announcement, either favorable or unfavorable to the resolution of tariffs in the middle of a trading day, the stocks can just, go one way or another very quickly. But it's not always the right response. I mean, the market reacts, but often when you give it more time, even just a day, the market changes its mind. And so it's worth keeping that in mind. But I think relevant news, material news to an individual stock or a market, gets reflected in the share prices very, very quickly. There might be exceptions to that, but again, it gets reflected in the price one way or another. Doesn't mean the market is correct. Yeah. I'll give you an example. Well, the market may or may not have been correct, but when Apple released its earnings, their services line, I think it came in 50 million below what the street expected. I think it was around 50 million. Now, this is a company that makes tens and tens of billions of dollars. And I thought the market completely overreacted to that. And I don't know what it dropped, 5%. Of course, maybe the market will turn out to be right. I don't know. I was surprised at that reaction. Well, there was movement in the stock today, although there's always the question of why. I think its earnings were lower. I haven't even read the report yet. It could have been because of its stock portfolio, which the new or somewhat new GAAP requirements, they have to market up or down depending on what the market does. And Warren Buffett's not a fan of that. Let's see. I haven't read this yet. I need to, since I own the stock. So if you look at net earnings for first quarter of last year, it's 12, almost 13 billion, and this year 4.6. Investments were a big part of that. They lost 5 billion, but operating earnings came down too. And so, and I haven't dug into this to understand why. I'm sure Warren Buffett discussed it, but I must have missed that part of the meeting. I didn't watch it all. I will read this. Actually, we can look at some of their insurance underwriting was down. I guess that was the big one. Oh no, this one, other. After foreign currency exchange losses, 713 million. Well, I guess that makes some sense. So the market could have been reacting to this as much as anything else. Obviously, I suppose it could include Warren Buffett stepping down. The news outlets try to answer those questions. I never have much confidence in their answers. Okie dokie. I've started watching the current season of Bosch Legacy. I love that show. And I like Bosch too. Apparently, Titus Welliver was in an episode of, I think, Equalizer, which I found odd. I didn't see it. I don't know. Can anyone confirm or deny that? I actually have a friend that I know from my online business who is a distant, I don't know what he is, cousin, nephew, I don't know, of Mr. Welliver. He has the same last name. And I was saying to him one day, I said, it's funny, you and the guy and Bosch have the same last name. Oh, yeah, we're kind of related. Oh, well, that would explain it. Here's a good question. If the new Berkshire bought 100 million in Bitcoin, would you sell? I would be very, very concerned if they did that. Very concerned. Can you imagine what the price of Bitcoin would do if that happened? JP wants to know how I feel about the Shiller Cape, which is what we just looked at a minute ago. And are there ones for international or small cap stocks? I was looking at that very issue a few months back, and some folks emailed me some data. It's out there, but I can't tell you where, and I don't know how accurate it is. I think it's a reasonable measure of value, the historical value. It's high, but the thing is what do you do about it? I look at it, here it is. I don't do anything about it. I guess I worry a little bit, but I don't. I think the only thing that I would probably do with it is that if I were retiring today, I would be very concerned if my retirement plan required me to pull out much more than 4% the first year, because the studies tell us that there's an inverse relationship between the Shiller PE and the safe withdrawal rate. Now, remember, 4% is sort of the bottom. And again, that's not a guarantee for the future, but if we just analyzed a safe withdrawal rate based on history in the US, 4% is sort of the worst. There were some years you could have started with 10%. But if you look back here, the 10% years are going to be, these years where the PE is way, way down here. They're not going to be when the PE is way up here, right? And in fact, we can look at that. I can just show you that. If we go to FI Calc, which we've looked at many times, and let's go to $1 million portfolio. We'll do 75-25. Whoops. 0% cash. Shouldn't change this too much. But let's do 80,000. So that's an 8% withdrawal rate. It still succeeds, meaning you don't run out of money in 30 years, 30% of the time. And if we come down here and we look at all the years, like look at 1982. Not only have you not run out of not only did you not run out of money, but in 2011 you had 2 times the amount you started with, right? But if we go back to the Shiller PE, that's right here, right? If you look at like the mid 60s, when the Shiller PE is relatively high, it's still much lower than it is today, by the way. Keep that in mind, right? But mid 60s, lots of red X's, all fails. And you can actually drill down into this and say, okay, how long? Look how quickly you failed at 8%. It's just a nosedive. So, yeah, I think if I were retiring today, I would be thinking about this in terms of my safe withdrawal rate. Absolutely. So if my plan required me to take out 6 or 7%, I wouldn't retire. It's kind of the point I'm making. If that wasn't obvious. I don't have confidence. The 4% rule may or may not be safe. Frankly, if it dipped below that and it turned out that it was 3.8%, probably not a huge deal. But I wouldn't be expecting a 7 or 8% safe withdrawal rate. In this market, given these valuations. Now, of course, you could say, well, this is S&P 500. I own some international and some other things. Yeah, and that helps. Definitely. Absolutely. But I'd be cautious. That's just me. Is it time to buy gold? OTM, I guess that's out of the market. Calls to hedge US dollar risk. Well, let's noodle on that one for a bit. First of all, why do we want to hedge first of all, what is the US dollar risk? What's that mean? Particularly for us in the US, we pay our taxes in US dollars. What's the risk? The US dollar goes down in value relative to other currencies. I assume that's what you mean by US dollar risk. So that's going to make goods we import into the US more expensive. It's going to make goods we export out of the US less expensive to foreign buyers, putting aside tariffs for a moment. It might make travel overseas pretty expensive. But other than that, I don't know. What's the risk and why do I care? That's a question. I don't know. I can't think of why I care. I mean, care in the sense of I want to go out and buy insurance, because that's what you're saying. Should we buy insurance? Should we buy an insurance policy that's expensive? And then even if we think we need to hedge the US dollar risk, is gold the way to do it? I don't know. I guess it depends why we're hedging. If you're hedging because you're going to take a 1-month trip to Europe in August, just buy euros, right? I guess you could do futures. I probably wouldn't fool with any of that personally. But I don't know what the risk would be that I would feel a need to hedge to begin with. And if I were going to hedge, I'm not sure gold, what's my confidence that gold is going to turn out to be a good hedge against the falling dollar? I don't know. Yeah, I guess you need people smarter than I am to figure that one out. Those are just questions. I don't know. I don't think that way about my investments. Maybe I should. Thoughts about Vanguard dropping expense ratios on many funds? Well, I mean, I always like lower expense ratios. I wish they would invest more in technology and customer support, though. So there's that. Terry says that in a previous show, I showed why VMFXX, money market fund, did better than B&D over a 5 and 10 year span, 2 bad years. Maybe that's why Christine Benz was saying that cash is a better diversifier. I just don't remember what her reasoning was. But even then, I would say, over some period of time, it might be. Long term, I'm not sure I would count on cash. And there's also the question of, I mean, diversification is important, but there's also just the question of expected returns. Cash has been great lately. It's coming down. But long term, if history repeats itself, it will do better at times, but long term, probably not better overall. But again, time will tell. Okay. HT says, newbie question, one of the differences between ETFs and mutual funds is that ETFs do not support automatic reinvestment. Could you help with what that means? And I don't know if that's true. Haven't some brokers started doing, let me see. Maybe they don't. Well, here, so I did a quick search. It took me to Reddit. Someone on Reddit says Fidelity added this feature in 2023. So you could set up automatic investments where it's automatically investing a certain amount of money, let's say each month. and they would pull the money from whatever your core cash position is. So at least according to this, Fidelity does it. I don't know if others do. Yeah, here we go. Set your investing on repeat. Choose recurring investments in stocks, mutual funds, ETFs, and Fidelity basket portfolios directly from your Fidelity account or your bank. There you go. What is the best way to move your IRA to another institution like Vanguard or to Fidelity and not have issues? Well, they have departments that help you with this. So what I do, I haven't moved an IRA in a while, but I would call the broker I'm going to move it to, and they'll usually walk you through what they need and how the process works. So in this case, I would call Fidelity. You know who? I moved a small IRA to Robinhood. Now I've since moved it out. It's now actually, I moved it out of Robinhood because I put it in, I put it into our solo 401k. It was the smoothest process, smoother than any other transfer I've ever done. Robinhood and their customer support was phenomenal. I was stunned. Now, I still haven't gotten my 3% cashback credit card from Robinhood, and I'm very upset about that. By the way, I'm not promoting Robinhood. As someone, at my age and with retirement and cash needs, and I would not use Robinhood. They're just not the kind of full service company. And, I have some other issues with Robinhood, but their customer support and their app and the transfer was seamless, easiest I've ever done. But in any event, I'd just call Fidelity, start there. Shouldn't be difficult. Anthony points out that when Warren was 11, his father was a stockbroker. It definitely helps. Definitely helps. He had a sister who since passed away, but she lived in Fredericksburg, which is about an hour south of Washington, D.C. And I had a friend who ran a charity that she supported financially. And so this friend, it's actually my wife's friend, my friend too. We're friends with, it's a couple, they live now down in, not that this matters, they live down in Richmond. She would meet with Warren Buffett's sister from time to time. And she was by all accounts, I'll say frugal as Warren Buffett. And it's funny, the stories. I mean, they really watch their money. And, good for them because they give it all to charity. So, I mean, I wish every billionaire did that. Many of them do. Some of them don't. Anyway. All right. I can't believe it's almost 8:30. Let's see here. I'll shoot to the bottom of the chat. I always like to end on a non-financial question. What do you guys got for me? Anything? Yeah, they reinvest dividends for you. Maybe that was the question. But I didn't interpret it that way, but I may have gotten it wrong. I've had a crazy year. It's been incredibly busy for a lot of different reasons. One of them, I've been going to PT twice a week for my shoulder, and she just digs into the shoulder. I mean, she needles me. I get 20 needles, neck, shoulder. That's fun. It's actually not that bad. And then she's got this like metal thing. It heats up and she digging or scraping. Like, oh my goodness. I mean, it's excruciating. And I've been taking a history class. The last class is this Thursday. That's been fun, but very busy. And a lot of different things are sort of coming to an end over the next 10 days, including that class and the physical therapy. So I think things are going to hopefully slow down for me because, at different times I've not done a lot of videos for the channel. There's things I want to do on the website to show you guys. So I'm going to be able to get back at it. So I'm kind of excited about that. Oh, I'm doing red light therapy for my shoulder. I don't know. It looks like a tanning bed. It's not. I don't know if it helps. No idea. This is what, as you get older, these are the things you do. Well, it's 8:31. Okay, we'll end with this because there's an obvious answer. Yeah, it's clearly chocolate over vanilla. So there's a place that we stop at when we're heading. I can never spell the thing. When we're heading to the beach. So if you're ever in the Denton, Maryland area, or it could be Rehoboth, they have one there. They have one in Fenwick Island, Delaware. This is about the best ice cream you'll ever have. Here it is. Vanderwin's. Excellent. And I'll warn you, if you go there, you'll see they sell 1 scoop, 2 scoops, or 3 scoops. Just get 1 scoop. It's ginormous. We took a friend and we said to her, just get 1 scoop. She got 2. It didn't go well. I mean, it was massive. Excellent ice cream. I'll leave you with that. All right. Well, it is 8:32, and it's practically bedtime for me. I mean, I'm exhausted by 8:30. It's ridiculous. And the shoulder too has been affecting the sleep. It'll wake me up. That's not good, but it's getting better. It's still not 100%, but we'll see. Hopefully. All right, enough of that nonsense. Well, have a great week. I should have some videos come out this week, but definitely starting next week, I'll have more time. And still doing the 5-question Friday videos. So the best way to submit a question is just to subscribe to the newsletter. You can do that with the link below the video. When you get the newsletter, I was just getting emails, people would reply. And then I said, this is being too hard to manage. So I created a form and you could ask your question in the form. Honestly, that's hard to manage. I have probably close to 1,000 questions. And I am looking at the form, but I've got sort of gone back to just hit reply to the newsletter and email me your questions or comments or whatever. And I read them all, and I'll do my best to reply to as many of them as I can. So that's kind of where we are. But that's how you can ask a question, and I'll try to tackle, 5-question Friday. I'll do my best, 5 questions a week, and just try to get her done. So there it is. Hope you have a great week. And remember, until next time, the best thing money can buy is financial freedom.